Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to the new business week with a brand new episode of Money Talk for Monday, the 18th of March. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, prices for new and second-hand homes in China's major cities declined in February as the country's property downturn deepened despite a record cut to the benchmark mortgage rate last month. The National Bureau of Statistics said that on a month-on-month basis, prices of new homes fell 0.3% in Tier 1 cities. On a year-on-year basis, new home prices fell 1% in first-tier cities, a bigger decline than the 0.5% seen in January. The price of second-hand homes in the country's most developed cities fell 6.3% in February compared to the same month last year. That was the worst year-on-year decline since the government started releasing data back in 2011. China's central bank left a key lending rate unchanged for a seventh month when it rolled over maturing medium-term loans on Friday. The People's Bank of China kept the interest rate on its one-year medium-term lending facility loans at 2.5%, a rate that's been in place since August 2023. Japan's largest trade union, Rengo, said that workers at the country's biggest firms are set for the sharpest wage spike in more than 3 decades. Bank of Japan Governor Kazuo Ueda has repeatedly said that the outcome of this year's wage negotiations will influence the central bank's decision on when to exit the world's last negative interest rate policy. Japanese unions are said to have won over 5% in wage hikes on average, compared to expectations beforehand of 4.1% from the wage talks. Honda and Nissan will work together on electric vehicle technology in a deal bringing together Japan's second and third largest car makers as they try to survive the upheaval brought by the influx of China's low-cost high-tech cars. The potential partnership could help the two develop economies of scale in producing EVs as Japan's automakers face heavy competition from China's BYD, Tesla and others. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Sam Faveur, CEO at Mandarin Capital. And providing a view on Mainland China is China specialist and author Mark O'Neill. If you want to get in touch, as usual, please go to my website, peterlewismoneytalk.substack.com, and take a look at my Asia Business newsletter.
Peter Lewis's Money Talk.
US stocks notched their first back-to-back weekly loss in more than 4 months, with investors now looking ahead to several central bank decisions this week. Tech stocks led the broader market lower Friday. The S&P 500 lost 0.6% to close at 5,117. The Dow dipped 191 points, or 0.5%, to finish the session at 38,715, while the Nasdaq Composite slipped 1% to 15,973. Small caps and big tech were the week's biggest losers. The S&P 500 shed 0.1% last week, the first straight weekly loss since October. The Dow was flat on the week and the Nasdaq dropped 0.7%. A slew of economic data pushed the benchmark 10-year Treasury higher by about 23 basis points last week. Yields all ended back up near their year-to-date highs, and the Fed will begin its 2-day policy meeting tomorrow. The dollar surged last week as speculation about the Bank of Japan's next move picked up, ending with its best week since mid-January. The US dollar index rose 0.7% over the 5 sessions to 103.45. The yen came under pressure, despite a strong outcome to the Rengo wage tally. The yen fell 0.5% Friday to 149.02 yen per dollar and was down 1.3% over the week. The Chinese yuan was unchanged in Shanghai at 7.19.5 renminbi ahead of today's February activity data. The dollar's gains were gold's losses as the precious metal ended the week down 1% at $2,156 an ounce. Crude oil futures fell slightly Friday, but gained for the week after rising in the 2 previous sessions. The Brent contract for May lost 0.1% to settle at $85.34 a barrel. The global benchmark was up 4% over the week to its highest since early November. In choppy trading, Bitcoin was above $72,000 late Thursday night, but suffered a steep drop overnight, and cryptocurrency holders on the east coast of the United States woke up to a decline of around 7% on Friday. Bitcoin ended the week about 2% lower, just above $67,000. On the mainland, Chinese shares rallied, with the Shanghai Composite up 0.5% to 3,055, and for the week, the index was up 0.33%. Hong Kong shares led the declines in Asia Friday, with heavy losses in the tech and property sectors. The Hang Seng Index closed 241 points lower, or 1.4%, at 16,721. And for the week, the Cities Benchmark Index was up 2.2%, the first rise in 3. Futures markets pointing to a rise in the Hang Seng of about 25 points. At the open this morning, looks like the Hang Seng will start trading at around about 16,745. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Monday morning guests. We have with us Alex Wong, Director at Alex KY Wong Asset Management. Morning to you, Alex.
Good morning, Peter.
And also with us is Sam Faveur, who's Chief Executive Officer at Mandarin Capital. Morning, Sam.
Morning, Peter.
Prices for new and second-hand homes in China's major cities declined in February as the country's property downturn deepened. That's despite a record cut to the benchmark mortgage rate last month. The country's National Bureau of Statistics said that on a month-on-month basis, prices of new homes fell 0.3% in Tier 1 cities. Sale prices also slipped 0.33% in second-tier cities, which was a slightly smaller decline compared to January. And in third-tier cities, prices dropped 0.4% from January. On a year-on-year basis, new home prices fell 1% in first-tier cities. That's a bigger decline than the 0.5% seen in January. The price of second-hand homes in the country's most developed cities fell 6.3% in February compared to the same month last year. That was the worst year-on-year decline since the government started releasing data back in 2011. Alex, what do you make of this data? It doesn't seem to be getting any better, does it?
Yeah, I think first of all, this is probably affected by the Chinese New Year. So this is a little bit exceptional. But anyway, I think the property market will still be bad. I think home buyers still know that they can wait. So I think this needs something to reverse the trend. But anyway, I think this is quite difficult. So very likely we will see the property market in an L-shaped type of recovery in China at best. So we are not likely to see any revival. But this data, I think, is affected by the Chinese New Year. So it's a little bit exaggerated.
And when you say an L-shaped sort of recovery, in other words, it's going to flatten out, how long is it going to stay like that for?
Oh, I think it will take long because the inventory build-up is huge and the debts by the developer sector are huge. So people know that they can wait and that will take a very long time. And also the manufacturing sectors are being affected. And there's not much economic driver. So I think this will take quite long.
Sam, what are your thoughts?
Well, I think if we're on an L-shaped type of market, we're still on the vertical side of the L. Obviously, there's quite a lot of issues. We still have market confidence, buyer's confidence not back. We've got oversupply, which is ongoing. And then we've got long-term trend with declining population, which is clearly not supported. So I think if they really need to want to find a floor to this market, they will have to be a lot more aggressive to try luring the buyers back. At the same time, I think we are seeing what's the situation, the effect of the situation for the last 10 years. People were asking if there was a bubble in some of the Chinese property. I think it's exactly what we're seeing, oversupply for a sustained amount of time. And now we will have to see repricing. And if anyone looks at history in other countries, it could take a decade. I mean, if we're looking similar to Japan's situation, not saying it's exactly the same, it could drag on for a very long time before we have stabilization.
And if we're in this L-shaped style sort of decline and then flatlining, is there still quite a way to go before we find the bottom in housing prices? Because we're still not, the government still isn't really letting the market find a true clearing level at the moment, is it?
Well, one of the problems, there's so much wealth attached to the property market and so much savings. I think they're very concerned if they let the price slide too quickly, that could cause a lot more damage to the short term to the economy, and with damage in the economy, it's potentially also social implications. So they are trying to manage that in a very, very careful way. So, but the problem, if you can't find a price of equilibrium and it takes a lot more, you don't let it go, at some point it will take a lot more time. I think we enforce a long period of declining prices. I mean, 6% even year on year is not big by any standard of correction if you look at general markets.
So when you talk about a long period, this is not months, you're talking about years.
Yes.
Alex, is there anything the government can do to try and reverse this sort of downward spiral and bring confidence back to the housing market?
I think that they won't do too much things. I think they will let that just correct naturally. I think they will just try to slow down the decline. But I don't think that they can reverse the situation because inventories actually are built up, and as Sam pointed out, the demographic situation is not supportive as well. So I think they cannot do many things to reverse the situation. At best, they can just try to stimulate the demand a little bit by lowering interest rate, but I don't think that would be a very good effective measures. So I think they cannot. They have not much tools actually.
And it seems that the secondary market is doing even worse than the primary market. There's always a lot of focus, isn't there, on the new home sales and prices, but the secondary markets, it seems to be sliding even faster.
Yeah, because in the primary market, actually, the seller can do many things. That they can give out many probably appliances or gifts. I think they can manipulate a little bit on the price. So that's why the data would be more scary on the second home market because of the seller there cannot do too many things to make the price look higher.
So this is going to be a drag on the economy, presumably, for quite a while.
Oh yeah, of course. This would be a major drag in the economy because if you feel your wealth is going down, then probably you would be a little bit cautious on your consumption. So I think that of course would be a drag for quite some time.
Sam, what's the sort of economic implications of this? I mean, presumably, this is the number one issue, really, isn't it, for the economy at the moment?
Yeah, so that creates deflationary pressure and obviously impacts consumer confidence. And also, it has an impact on the amount of investments because if there's already oversupply, and given how much construction sector is, and as part of the Chinese economy, it's going to be very, very difficult to keep at that level. So you have double pressure from the demand and supply, which is going to be very, very difficult to manage. So it is all about recalibrating the economy towards other side of consumption and redriving savings away as well from the real estate sector. But at the moment, there isn't really much where the Chinese investors can really diversify. The stock market hasn't proven very, very successful for them. So it is a tricky situation at the moment.
And it's hard to find an economic driver that can be as big as the property market that can replace the sort of economic activity that's lost there because it's been so vast, hasn't it? I know the government's trying to direct investment into some of the manufacturing sectors like electric vehicles and solar panels, but this can't really make up for the decline in the property market and damage that's caused to the economy.
The problem is the cycle's timing is very different. I mean, a reinvestment cycle into new economies is something like 5 to 10 years. And even if you try to put consumption as a driver of the economy, that also takes a lot more time. Well, now they're facing a decline, which is 1 to 2 year cycle. So it is something which is difficult to manage. But at some point, I guess you don't have the choice. You have to take the pain to make sure you are readjusting your economy. I think one of the issues is probably it's been done slightly too late.
Mm. Alex, why won't the PBOC cut interest rates? They left the medium-term lending facility on hold again at 2.5%. It's been there now since last August. They seem very reluctant, don't they, to cut rates, given what's going on in the economy, the problems with the property market. Why is that?
Oh, I think eventually they would. I think probably the biggest consideration would be the renminbi, and then I think we have a strengthening US dollar last week. But looks like to me they probably would not like the renminbi to be down in a very fast pace. So I think that's probably the big consideration. So I think if the US dollar softens, then probably they would cut rates more aggressively then.
Is the People's Bank of China struggling with the right policy levers here? Is it maybe not sure whether it's got enough tools at its disposal to try and deal with this?
Well, I think first of all, the overall situation is bad, but I think that it still looks manageable for them properly. So they are not too aggressive in cutting rates, but. Anyway, I think this is very difficult. I think they need to accept the pain because the inventory build-up is so huge during the last decades, and the situation actually must be changed. So I think they probably know that they can just slow down the adjustment process, but they will have to accept that process is inevitable.
Mm. And are you worried about some of the things that are going on with the property developers? We had China Vanke downgraded last week by Moody's. We've got Country Garden defaulting for the first time on a yuan loan. How big a problem is this?
I think, of course, it's a big problem, but this problem actually is well known, and I think that people have adjusted their positions accordingly. So this is spread out to the wealthy people or the FI in China. So I think the overall impact may not be like Lehman in the past, but of course this is a big problem because the amount involved is very huge. But the point is that those people probably have accumulated a lot of wealth during the upturn as well. So this is not as scary as people think. But so that's why I think also they are not too aggressive in the policies making.
Sam, is the PBOC not being aggressive enough? Is it making a mistake in being reluctant to cut rates?
I don't think they necessarily have the choice. And I completely agree with Alex on the fact that they're probably trying to manage the potential capital outflow and the yuan. So I think that's the biggest problem they are facing at the moment, because if they had a stable currency, I think they would be a lot more aggressive. Now, regarding the impact of the developers' default, I don't quite necessarily agree on the fact it's not systemically important. I think one of the issues is it will be having a second round effect, and maybe a third round effect, because of how this thing is going to spread to the suppliers and to the whole supply chain. So it's not something which is necessarily as easily manageable or as systematically manageable as a bank, because you don't necessarily can forecast the actual effect on those kind of defaults. Mm-hmm. At this stage, we have only one big one that has defaulted, but a lot more will default. And how much will be the impact in 2 to 3 years? Given that no one really knows the quality of the books at the bank, I think that's at this stage it's a very big question mark. I mean, it's not something which is going to be dramatic in the next 3 months, but that's something which could accelerate and have a huge impact in 1 year time, for instance.
It seems the government's happy to try and do some things to help Vanke because it's basically government owned, isn't it? It's owned by the Shenzhen municipal government. Doesn't seem to be so keen to help Country Garden.
Well, yes. I mean, obviously, when they have an interest, they will be putting money up. But at the same time, I think they also have to, mitigate the risk of spreading. At the same time, they have to let some go under to make sure this moral hazard doesn't continue forever. So, it's a very, very thin line. People are walking on this.
Alex, we also had some loan data out of China on Friday. It looks like new loans dropped more than expected. Existing loans also dropped quite sharply, and total social financing also below expectations. So it seems like credit is sort of is tightening a little bit, doesn't it?
I think it's also probably affected by the Chinese New Year situation. So we need to see next round data. If they want to push up the data, they could do it easily. I think the banks are probably would be very willing to lend out if they are asked to. So I think they would comply, I would say. So I think we need to see the data after the Chinese New Year, because this affected quite a lot on the last one, I think. So I would not pay too much attention on that right now. I think with the next data will be more important.
Oh, okay. Let's turn our attention to Japan. Sam, Japan's largest trade union, Rengo, said that workers at the country's biggest firms are set for the sharpest wage spike in more than 3 decades. Japanese unions are said to have won over 5% in wage hikes on average. That's compared to expectations beforehand of about 4.1% from the wage talks. Sam, is this now all systems go for the Bank of Japan?
Well, they have to do something. I mean, they've been behind the curve in terms of reacting to inflation. It's been lingering and accelerating in Japan, at least for the last 2 years, and now it's going to be passed on to the wages. So I don't think really now they really don't have the choice to start adjusting. And again, when central banks are behind the curve, they will have to adjust a lot more than what people think. So I think we're up in an up cycle. And let's see where it takes us. But there is genuine inflation throughout the Japanese economy now.
So this is eroding those wage hikes that the union members have just achieved.
Well, I think if you look for the last 4 or 5 years in terms of the general food staples or these kind of daily living prices, and even real estate, it's gone up massively. So. Yeah, I mean, they don't really have the choice to start raising prices, because I think there's quite a lot of discontent with the workers in Japan. So, and again, I think the Bank of Japan has been at least 12 months too late in terms of reacting to this. It's been there for a while now.
So people are thinking that even if rates do go up, they're minus 0.1% at the moment. They're not going to go up very much. Do you think maybe people are underestimating what the Bank of Japan will need to do? They may have to raise rates further than analysts are expecting?
I completely think so, because the problem is habit in the market. People haven't seen inflation and positive rates. So, and we're looking at generations, probably 30 to 40 years, since people have been used to those kind of situations. There is actually no memory or experience of this kind of situation in Japan. And they will have to raise up. There's no difference in Japan to the rest of the world when it comes to inflation, money supply, and money demand. So they will have to react. And inflation is up, and inflation expectations are going up. And now this is passed through the wages. So it will have to be more aggressive than moving from 0.1 to a quarter, because let's face it, it's not really tightening. It's just marginal.
It's not really normalising rates, is it? Or certainly not what we would understand as normalisation of rates.
Clearly not.
Alex, what do you think? Sorry, Sam.
So go ahead. Sorry,
Alex. What are your thoughts on this, and what is it going to mean for the markets?
I think it means probably we may see as the yen to strengthen in the long term. I think it is now not too bad. I think people still expect the BOJ to be conservative in the policy. They probably may just raise the rates by a marginal amount. So it's not normalizing too much. So that's why I think the yen remains under pressure and not going up too much. But I think that will eventually go up. I think the dollar yen probably has a peak already. And for the market, I think people will look towards another group of equities in the Japan market. Right now, in the past, the rise was fueled by those exporters, especially in the semiconductors space. But next one, I think probably may see people to look towards those companies which would benefit from wage rise and more consumption power domestically, and also probably they would still think the tourism may have some room to rebound, because China tourists actually are not coming back to Japan too aggressively right now. So we probably may see another group of equities to go up, while the previous winners may have some pressures in the longer term.
So overall, you remain positive on Japanese equities?
Oh yeah, I think the fund flow remains okay, and I think even though I expect some corrections on the expected space, but those companies with the edge in technologies probably will still be supported, and also some retail names which has the ability to expand overseas, I think should still be okay. So I think overall Japanese equities will still be okay, but the winners probably may belong to another group instead of the previous one.
And what happens if the yen does start to appreciate? Does that make it more difficult for Japanese equities?
It will make it a little bit difficult, because some of the appreciation will go towards the yen instead of the equity price. But I think the overall trend will still be okay.
Sam, what are your thoughts on the markets as the Bank of Japan starts to raise rates? And does this change sort of capital flows? Does capital start going back to Japan, or is it just too small at the moment to make any difference?
Well, I think a lot of capital has been going back to Japan, which is the other markets. I think at this stage it's going to be, as I said, fairly benign. But it depends how quickly and how far they're going to go, because just looking back where the rates were in Japan in the 90s, we're looking around 8%. So I know the interest rate environment globally was different, but if we're looking to normalization, even where they were in the 80s, so around 5%, there will be a lot of damage to this market if people don't start appreciating that interest rate might go up significantly. So I think we are probably going to clearly see a reversal in the yen. And given the run, and I think in terms of valuation, the Japanese market now is not as cheap as it was. I think might as well start taking money off the table.
Do the Japanese pension funds, who have got lots of money overseas, haven't they, in US Treasury bonds, at what point do they start thinking about repatriating that?
Well, I think the Japanese pension funds usually take a lot of time to make decisions. So I think it's going to depend also what's going to happen to monetary policy in Japan. But if you start closing the differential gap between the interest rates, this big carry trade, which has been ongoing for the last 20 years, could start to unwind. So I think you will see that. Not now, not with a 4% differential, but if you start closing, reducing that by half, I'm sure you will see some repatriation of these big yen positions. So a big dollar position into yen.
Alex, what about local markets here? How important, first of all, is the situation with TikTok? Not obviously, TikTok's not a listed company, but nevertheless, is it having damage on sentiment and towards sort of the Chinese markets overall?
I think no, because we do not have companies like TikTok listed in Hong Kong. Tencent, Alibaba actually are not too strong in their overseas business like a TikTok. So that would not affect too much. Actually, a TikTok existence in China is affecting the market in Hong Kong, because in the past we probably more tilted towards Alibaba and Tencent, but the rise of the ByteDance actually means that many businesses will be threatened by them. Like Meituan, people are talking about the acquisitions of Alibaba business by TikTok, by ByteDance, so that is affecting the Meituan right now. So I don't think these TikTok things would affect too much on the sentiment here. But of course, we are a momentum market. So after the short covering rally, we are now correcting. And I think people would still be cautious on the long-term value here. So we probably will still be ranging. And the direction probably may not, the long-term direction probably may not emerge soon. I think people will still be cautious on buying long-term, but they don't want to short the market, and they think the valuation is cheap. So probably we will be stuck within a small range.
Does this remind people of the risks, though, that just how bad US-China relations are at the moment? Is that maybe going to be an overhang on the markets?
I think if that happened, I think that would affect the EV space more more than the internet space. I think EVs probably may be more affected because the exports business probably would be affected in the long term. So that track probably would be on different sectors rather than the internet sector.
Sam, what are your thoughts about TikTok? It's a very unusual situation, isn't it? Where we've got the US government in effect trying to force shareholders to disinvest themselves from a major company.
It is unusual, and can argue it's very pushy as well. Now, I think in terms of impact, it's probably going to be minimal first because it was flagged already a long time ago. And I think it's really specific about that company. And I think globally, the market is a lot more concerned by the domestic intervention, domestic policies, which have been really driving the market up and down in China, rather than just this one of which, it's good for politics and making noise and, for the US, especially in the presidential election. But I don't think that's really going to have a massive impact on the overall sentiment in the market. I mean, a lot of potential regulatory risk and US tension is already priced in this market. I think the real issue now is getting back confidence, and the confidence is going to come back from the Chinese, the Chinese authorities. How they're going to manage to make sure that people have trust in putting their money back in Chinese equity.
And are you satisfied with the steps that the regulator is taking in terms of cracking down on quant funds, banning short selling, even stopping some of the long-only funds from selling as well, the state-owned ones, certainly?
Well, if you stop selling, the market is certainly not going to go down anymore, but I don't think it's going to bring anyone's confidence to put their money back. So I think the biggest issue has been policy intervention in this market. And as long as they keep on, changing the rules on a daily basis, people will not put their money back. So that's really one of the biggest issues in China. They need to let the market behave in an orderly fashion. But short sellers are important to the market for lots of reasons. One, for hedging. And you need to be able to take your money out of the table. Otherwise, there's no way you're going to invest in the market. So they need to make the market investable again. And they need to look very, very clearly what they want to do with the equity market in terms of channel for capital and also for savings for the domestic population.
And of course, that's a big issue, isn't it, for investors, that they feel that, first it was quant funds, it could be them next, and they end up being trapped in the market and unable to sell and unable to withdraw their money.
I think that's the biggest thing you can do in the market is just preventing people to get their money back. Yes, you could have panic, but you can put some triggers to make sure there are circuit breakers. But just forbidding people to get their money back is something which is always very, very bad. And people remember that as well. So before people will think again at investing, it will take a lot of time. So you have a double confidence issue from international investors and from domestic investors. That's going to take a long time for recovery. So I agree with Alex. We probably have found a bottom in terms of market because people really cannot sell anymore, and really the valuation drop has been so steep that there's probably not more downside. But before people decide to put money back, it's going to take a lot of time.
Alex, has your confidence been damaged in the market?
Not much. I think we are still okay in Hong Kong buying and selling. But I think the ban on selling probably would be affecting people's commitment in the long term because they know that the risk of exiting is higher now. So I think that probably may still make the market very difficult to move much higher, and the valuation particularly would still come down. So I think overall, I would not be too aggressive in going in China, Hong Kong. I think probably the best one would still be the ones that we chose a long time ago. Those are defensive ones.
And how significant are all the central bank meetings this week? We've got a number of them. About 40% of the world's economy has got its central banks meeting this week. Obviously, the Bank of England, the Bank of Japan, the Fed, everyone watching the Fed and the Bank of Japan this week. Is this going to be significant?
Yeah, I think it's quite significant because inflation data in the US are much more stickier than we think. So I think people would take that very seriously because right now the market actually is a little bit undecided. The market is more resilient than people think after last week data. So I think people are still hoping for a rate cut quite soon. So I think the Fed meetings actually would be quite important this week because people are having some divided opinions on the timing of the cut and on the magnitude of the cut this year. So I think that would provide some clue.
And we've seen some of the biggest moves actually in the bond markets, haven't we? The 10-year Treasury yield's about 23 basis points higher over the week. And we're getting to the point now where US equities are going to struggle to make headway if we start to see yields push up further.
Yeah, of course. I think right now the equity markets are supported by the AI theme. So that's why the bond market and the equity market this year actually are going in opposite directions right now. But if rates continue to go higher, then I don't think equities would continue to perform like this. So that's why this week would be quite important because the bond market actually are more bearish right now.
Sam, final thoughts from you. How significant is this week?
I think it's always fairly significant. And I think in the US, I would probably think they're not going to happen much because they're in a good situation. The market's very stable, record high. They don't have as Alex said, it's very sticky in terms of inflation. There is no real reason to be aggressive on the rates yet. So I think, Japan is important. Europe is going to be quite important as well because they maybe a slightly different cycle compared to the US. So yeah, it's going to be a very important week this week.
And bond yields, they're moving higher. They're getting at the point where they are starting to affect stocks now in the US, aren't they? We saw that certainly towards the end of the week anyway.
Well, yeah, I mean, in the US, there's been such a tremendous run across the curve. To be fair, I think there's going to be a lot of reasons now to start selling the US equity. So rates might be just one of the excuses, but I think there's definitely taking money off the table is something which is going to be, the way forward for a lot of people on this.
Okay, well, thank you very much for your thoughts. Have a great week. You heard there Sam Faveur, who is Chief Executive Officer at Mandarin Capital, Alex Wong, who is Director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by China specialist and author Mark O'Neill. Morning, Mark.
Good morning.
The MPC ended in Beijing just a week or so ago. What are your thoughts on the outcome from that and what stood out particularly from that meeting?
Well, I think two things stood out. The first one is the fact that the government decided to cancel the annual press conference of the Prime Minister, which has been held since 1993. And they said that there will not be any press conference during the current 5-year term of the Parliament. Now, in other countries, a press conference happens every day. There's nothing unusual. But what's unusual about this was it's the only day in the year when the domestic and the foreign media have the chance to speak directly to the Prime Minister. And whilst some of the questions are scripted in advance and the answers are scripted in advance, some of them are not. So you get a very rare opportunity to see the Prime Minister in person answering questions off the cuff. And I myself have attended some memorable press conferences in Beijing, especially Wen Jiabao, Zhu Rongji, where they speak off the script. So this is an event which journalists, domestic and foreign, very much look forward to. So why was it cancelled? Well, we don't know exactly, but the consensus view is that Li Jiang, the Prime Minister himself, didn't want to hold it because his power is very limited now. He's very much the secretary of Xi Jinping. So by having a press conference, he exposes himself to possible errors. because if people ask him questions for which he's not prepared, he may give the wrong answer. So we think that he himself didn't wish to hold the press conference. And also, there's not much good news to announce. I mean, you want to use the press conference to tell the Chinese public good news for the year ahead. And there wasn't very much to announce. So I think these are the two reasons it wasn't held. So that's the first news. The second news, of course, is what's going to be the GDP growth rate for this year. Now, in his work report, the Prime Minister said it would be about 5%. Last year, it was 5.2%. Now, remember, last year was compared to a COVID year. So actually, it was quite easy to reach the 5.2%. So the consensus among economists outside China is that China will not be able to achieve 5% GDP growth this year.
One of the things that stood out from the whole sort of two sessions, the MPC meeting, obviously what you said about the press conference being cancelled, is just how much power now is concentrated into just one person's hands. It seems like the Communist Party has taken over the government, all the functions of the State Council, of the Parliament, and not just the Communist Party, but basically President Xi Jinping himself as head of the Communist Party. Is it worrying people just about how much in control this one person is?
Well, as you know, Deng Xiaoping, when he took over the government in the early 1980s, he instituted a reform that the president could not hold power for more than 2 terms. Mm-hmm. So the maximum was 10 years. So that's how it has been until President Xi took office in 2012. And Deng's reasoning was one that was well accepted by Chinese, which is China must avoid the excesses of power in the hands of one man, which was Chairman Mao. And millions of people suffered from this, including Deng Xiaoping and indeed Xi Jinping himself also. So yes, many people are very anxious about this. And China is now an extremely large country. It's the second biggest economy in the world. It's got the second biggest military in the world. The economy is far more complex than in the Mao period. So, of course, no single individual can possibly master all the complexities of the economy and make decisions about manufacturing, about R&D, about monetary policy, fiscal policy, export policy. I mean, it's so complex. But as you say, the power is now so concentrated in one person that even were he a genius, I think it would be impossible to be on top of all these subjects.
Mm. So these reforms that Deng Xiaoping put in place are really being effectively unwound now by President Xi.
Exactly. I mean, we've ended an era. So let's say it was 78 when Deng announced the open door reform policy. So 1978 until 2012 when President Xi took office. So that was one era, and now we're in another era. We're now in the Xi Jinping era, and as you say, the party has extended its power, and the State Council, which is the executive, the cabinet. In the Deng era, it was of course subject to Communist Party oversight, but the Prime Minister and the State Council were given quite a lot of power, especially in economic matters. Mm. Now that has ended. The State Council has become the implementer of the policy set from above. And that's a very big change.
So we know that President Xi is number one. Who's number two? Who's his deputy? Does he have one?
Well, the answer is no. There is no number two, because if you have a number two, of course, you have a possible successor. And one of the features of the Dengist period was that the president always had his successor, in sight. Everybody knew who was going to take over from the leader. And the idea was that number two person would have experience, at the top levels of the government and the party, And therefore, when he took over, he would be very familiar and people would know him. Well, that's changed too. So Xi has not chosen a successor. He appears to want to remain in office for the rest of his life. So, of course, he doesn't want anybody to be number two who would either have the ambition to succeed him or would be seen by others as his successor.
The risk, I suppose, of that is that one day there's going to be, whatever happens, some handover, either enforced or otherwise, and it could be pretty chaotic.
Yes, well, the handover, of course, is not decided by the public. The handover is decided by the senior levels of the party. So that's what would happen. But as you say, the problem is we don't know who it might be, and we don't know the procedure under which it will happen. And of course, everyone fears it would be a power struggle between the people close to Xi at the time. And yes, it's not structured and it's not clear what would happen. And of course, this makes many people anxious.
And on the 5% growth target, does the government have the tools to be able to meet that at the moment, particularly given what's happening to the property market? And as we saw on Friday, the decline in the property market seems to be getting worse, particularly in the secondary markets.
Well, I think potentially the government have the tools, but what was clear from Prime Minister Li's work report was they don't intend to use them. The only one which will be useful is this special bond issue of 1 trillion yuan, which the government plans to inject into the economy. But that's not going to be enough, because if we look at the four big problems, which are the real estate market, consumer spending, the very high level of local government debt, and the very high level of youth unemployment, these are very serious matters that require very decisive measures. And I think the real estate's the most serious. China has 80 to 90 million vacant apartments. So a German friend joked to me that you could move the entire population of Germany into the vacant apartments. And the prices are going down. Millions of Chinese have bought apartments which are not finished. They have paid in part for their apartments, and it seems very unlikely that they will get their money back. And people are seeing the value of their main asset, because real estate accounts for 2/3 of the assets of the average Chinese. They're seeing the value of their asset fall. So they're very afraid of the future. They don't want to sell, and they're very disinclined to spend money. I mean, it's the real estate market plus COVID, the experience of 3 years of COVID, when millions of people were locked up at home, they didn't have jobs, they received only low pay. It's made Chinese very cautious. I mean, it was a traumatic experience. And the lesson is that you don't spend, you put the money in the bank for the rainy day. So solving this property crisis is an extremely difficult and complex problem. But the Prime Minister didn't come up with measures to address it.
And it seems that actually it's going to be very difficult to address, isn't it? Because to get people to start having confidence when they think the house prices, they're seeing prices go down more and more, it's going to be very difficult to get that confidence back. It's going to be a multi-year process.
Yeah, I mean, I think, the government's motive is good. I mean, President Xi said, houses are for living, not speculation. That's right. Prices should be lower. They should be close to what normal people can afford. And this is a very good objective. But the problem is the Chinese economic miracle, as we've discussed before, has been largely based on this virtuous circle of land sales by government, sales by developers to the public putting in money, often for flats that haven't been built. And the whole economic miracle has run with this circle. And now this circle has been broken. So it'll take years to unwind this, to sell off these 80 to 90 million vacant apartments, and to arrange the extremely complex financial arrangements. because, of course, banks have lent billions of yuan to property developers. Property developers don't have the money to pay them back. Nobody is buying their apartments. I mean, this can be dealt with, but it will take a long time, and it'll take a very complex plan, and it will need a lot of money, and the government's the only party with the ability to pay it.
And in the meantime, the government's pumping money into various favoured manufacturing industries like electric vehicles and batteries and solar panels. The problem is the overcapacity that's causing in those sectors. There's just no capacity or willingness for overseas countries like the US, like European countries, to go and absorb all of that.
Yeah, I mean, not only China, but for many countries, exports is the ideal way to push growth. I mean, if domestic demand is so weak, you sell your products abroad. And I think President Xi calls it the new productive forces. As you mentioned, it's electric cars, semiconductors, robotics, AI, new energy vehicles, materials, biomedicine, 5G and so on. I mean, these are all good sectors to spend money on, and these are the sectors of the future. But as you say, who is going to buy all these electric vehicles or indeed conventional vehicles? Now, last year, the best market was Russia. Chinese exports of cars to Russia rose 5-fold because Russians stopped buying cars made by European, American, and Japanese manufacturers. So that was a wonderful market. But the automotive market in Europe is much tighter, and the European automakers are alarmed at this capacity and also the high quality of Chinese EVs. I mean, that's the problem. Chinese EVs are better than those made by German, French, or Italian manufacturers. So the EU is now doing an investigation, and we all think it will result in higher tariffs on imports of Chinese EVs because they believe that the EVs here received large subsidies from the government, and so it's unfair competition. So, yeah, I think there are many products in which China will face resistance to a sudden increase in exports. I think a gradual increase in exports is okay, but to get out of this crisis here, China wants massive increase in exports.
That's China specialist and author Mark O'Neill.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Corinne Hearn, Partner and Chief Sustainability Officer at East Capital Group, and our US economics correspondent, writer and broadcaster, Barry Wood. See you tomorrow.
Money Talk.